Right. Good evening, everyone, and welcome to my webinar this evening, which I'm going to be talking about the FTSE 100, the markets, the state of where we are in the world today. And one of the key things I want to do this evening is give you a very efficient, effective input into where I think we should position ourselves for the rest of the year, and also give you some input onto how I'm trading the markets right at this moment. So make yourselves comfortable, grab a drink, pen and paper, whilst I still have a few people coming on. We've got pretty much everybody's online, but I do want to give everyone time to get on. And whilst I do that, let me say thanks very much for coming on to the onto the webinar this evening. Very much appreciate it. And what I want to do is just kick off, as I say, with a perspective of the markets as a whole. Just give me a second while we get everything just set up. Here we go, and show the screen. Just give me a second there to get all of this up and ready. Here we go. And what I want to kick off is with the FTSE 100. And now this image is going to be critically important for us in that it really explains what's happening in the broader markets. And it's actually been my benchmark for understanding all the individual stocks in the FTSE 100. Now, I'm going to mention some stocks in a moment, the ones that I like, and ones that I like for the next week, as well as the next month, and so on. But what I want to do is, first of all, just make sure, can everybody hear me loud and clear? I want to make sure that that's happening. And just ping on the question box, just so I know that you can all hear me, and as I get those all that coming through, then I know you can all hear me loud and clear, and that'll be good news. So just making sure that hello, yes, perfect, that's fantastic news. Thank you kindly, delighted that I can be heard. That's always important. Now, what I'm going to do is I'm going to answer the questions as we go along, but what I'd like to do for now is just have a look at this chart and let me explain it. As I say, it's the master chart for explaining to me exactly what's happening with the FTSE 100 and a lot of the constituents as well. So, first and foremost, look at where I've drawn the number one. What the number one there tells me is we've got the upward trend, which you're all be familiar with, an upward trend on the FTSE 100, which has really been going on for quite a while, actually, and a lot longer than even where I've drawn there, arguably. And the length of a trend line like that shows us that there's strength in the trend, as we would expect. No problems there, of course. And for people just coming on, don't worry, you haven't missed anything, just kicking off now. So given that we've got that trend, what can we expect with the FTSE 100 and its constituent elements going forward? Well, what I've also drawn there is a number 2 to make it a little bit easier. And that's the stochastic, and I'm going to come back to the momentum indicators later in the presentation, but with the stochastic, you can see that it's peaked, it's moving a little bit lower, and therefore we would expect it to suggest that the prices too will be moving lower. They're losing some degree of momentum. The MACD confirms this, which is number 3, and I'm expecting this to have moved lower as well. And that all of those things with the momentum at number 4 shows us that the prices have moved lower. However, what's my outlook therefore? What does all of this mean in terms of my outlook for the market as a whole? And why have I explained all of this in these terms? What it means, in essence, and what you've got to remember from all of this is, I fully expect the FTSE 100 to dip from where it is at number 4 to the trend line, which is marked 1, but not penetrate through it and then rebound off it. At worst, we're going to get for the next 2 or 3 months, we're going to get a sideways movement. At best, we're going to start getting a resumption upwards within a month. The bottom line of what I'm saying is this, and I'm going to explain why. I am bullish to the end of December, and any dips that we get over the next 1 to 4 months are buying opportunities. Now, I've got no incentive to talk up the market. I'm not selling a fund. I'm not selling brokerage services, encouraging you to go long, not selling a stock. I'm just telling you the way I see it, and I'm going to show you later on how we make money from the FTSE falling as well. My point is I can be pure in my motivations of analysis. And that's really important when we analyze things, because analysis has a lot to do with psychology, and we don't want to be clouded in our judgment by having an agenda to promote the FTSE rising higher. Now, just to sum that up, what I've said and what I see with the constituent stocks, and I'm going to mention the stocks in a second, which I see as the best of the bunch. What I see at the moment very much is the FTSE 100 dipping off momentum over the next few months, and that's partly a reflection of we've had a 10% rise in the American markets in the first quarter of this year. We've had a great rise in the FTSE for the first quarter of this year. So some of it's profit taking, some of it's sell in May, go away. These things become self-fulfilling, and statistically it's proven to be the case that May, June, July, or August tend to be pretty poor months, and some of it is just the fact that valuations in the short term have risen a lot in a short space of time. So then the issue arises, well, why am I then bullish for the rest of the year? Why do I think that we've still got room to go, given that the markets have risen so much so far? And which are the best stocks which I think will rise going forward? Which do I think will be the best ones to move upwards as time progresses? And as I said, what I'm going to do with this is go through individual stocks which I see as the best opportunities going forward, and give an explanation of why I think short-term buying opportunities, longer term. By longer term, I'm going to just talk to the end of this year, this calendar year, end of December, why I think there's buying opportunities. Now, I've explained it in technical terms. Let me just explain it more in fundamental terms as we continue with this. So, as I move into a more fundamental analysis, let me just explain one of the things we've got to do this evening is not just look to the end of the year, not just look to what's going to happen to the end of December and the equities that I like. I also want to cover for all of you what I think we need to do in the shorter term. And I mean almost on a day-to-day basis. This is an example of a chart, typical of how I would spend my time. So that's the UK 100, so the FTSE 100. UK 100 means FTSE 100. 30-minute, so M30 means 30 minutes. So these are 30-minute bars, 23rd of April up until the 24th of April. And you can see the entry, which is marked here. The arrow tells us the entry, and the blue line tells us when to get in, up to here. And you can see the 30 pips in a day, £40 a pip, that's 1,200 in one trade, 30-minute FTSE 100. So we need to know also, because a lot of us are interested in how to do that, how to make profits in that end as well as the longer term. And I want to explain to you the longer term equities that I like, and also how to trade the FTSE 100 in the shorter term as well. So how are we doing? How are some of the constituents of the FTSE 100? What I've done here, I explained this table, is list the 19 equities which stand out for me in the FTSE 100, and why they stand out and why I think they're the best of the bunch in terms of buying on dip opportunities. Now, one of the key things you're going to notice with all of these names is actually over the last 6 months, they've been doing rather well. Some are up 30%, 91% in the case of EasyJet. Over the last 3 months, they're all up. And also, on a valuation basis, price earnings growth, for those who don't know how pegs work, anything under 1 suggests they're undervalued, allowing for earnings growth. You can see that the vast majority, or rather, actually, about half of them are below 1. And that suggests that they're undervalued on a peg basis as well. You can see that with these. Not that I'm necessarily put off if they're well valued, because I expect these, with the price momentum that they've got, to continue upwards through higher and higher peg ratios. But my point with all of these is, when I looked at the individual chart patterns, as you would expect, they looked rather similar to the chart patterns. They looked rather similar to the chart patterns of the FTSE 100, because they're the constituents of the FTSE 100. Therefore, they're going to look rather similar to the FTSE 100 as well. And that meant for me that I was able, by analyzing FTSE 100, to get a pretty good idea of how each one of these individually would work. So why would we look at any of these individually over and above the FTSE? Well, the reason for buying individual stocks is because you want to outperform the index, and also by buying a selection of these, you're still diversified from owning just one, but not so diversified that you might as well just buy the index. So that's the balance we're trying to reach: outperform the index. Because if we weren't going to outperform the index, we might as well just buy the index and take all our time just doing that. So that being the case, what were the criteria that led me attracted to these? Well, it wasn't just the price momentum, obviously. It wasn't just the PEG undervaluation. There's a whole host of other factors that I look at. One of the things is is year-on-year revenue growth, year-on-year earnings growth. And I also then look at their valuation aspects. So not just growth, but valuation. Valuation meant price earnings growth, price earnings ratios. I also looked at dividend yields for each of these. When I put all of these things into the mix and then weigh them, because obviously price earnings ratios are more important, or revenue growth or earnings growth is more important than just dividend yields. So you've got to weigh these things. How do you decide what the weight is for each one of these things when you're considering which equities to look at? Well, that's to do based on the academic research, which shows, for instance, historically, that price earnings ratios are better predictors than dividend yields, for argument's sake, over a particular period of time. And for all of these holdings to the end of the year, for the period to the end of the calendar year, the point was simply this: that when I put in all of that analysis, so you don't have to, and look at the momentum, I looked at fundamentals and momentum, these were the stocks which were at the top of the pile. What does that mean for us? Well, I'm going to narrow this group into a smaller group in a second. What it meant with any of these is I'd be more than happy to be holding them to the end of the year. I'd be more than happy to be buying on dips with them if I hadn't got my full allocation in, or I didn't own some of them and I wanted to add more. But I'm going to narrow it down even further than these on the FTSE 100, even further than the ones with revenue growth, earnings growth, solid valuations, and dividend yield. So all of those things where I've said, look, you've got to jump so many hoops to be decent, to qualify to be one of the greats. I want to go from good to great. You have to do so much. One of the other things I wanted to do beyond just that was then narrow it down beyond just the FTSE 100, narrow it into equities beyond that, and I'm going to do that in a second and name you some names there as well, because what we're trying to do is filter all the way from the FTSE 100 to a broader market so we can keep outperforming. And to do that, we cast our net wide beyond just the FTSE 100 stocks, but a broader number of stocks. So looking forward at this, which is the 12-month holding period, I then filtered beyond just beyond the FTSE 100 and looked at companies that cover far more than that. And the reason for that is when you narrow your filtration between just valuation, growth, and income, and you just restrict that to the FTSE 100, then obviously you're going to pick from a pool of 100. If I widen that net but keep the quality criteria high, I should be able to get really good companies from a wider net. I mean, it's just logic. So what I did is, as a result of that, came up with these names, which was based on the criteria of valuations again, price earnings ratios, price earnings growth, revenue growth, earnings growth, dividend yields, and price momentum. Now, the rule I have with these, when I put all of this into a pile and filter through them with all those quality criteria, when I do all of that, what happens is, the good news is, when you do all of that, is that historically, what I've seen happen time and time and time again is a portfolio made of those stocks will, as a whole, rise about 20% in a year, as a whole, and that means in a 12-month period. 20% in a 12-month period. Any one of them might even go up as much as 60, 70%, but I couldn't tell you off the top of my head, oh, this one will go up 70%, or they all will, or whatever will happen. What actually will happen is, as a portfolio, that will occur, about a 20% rise, which is not bad for a buy, hold, and forget. 12-month holding period, buy, hold, and forget. Don't forget, I'm going to deal, as I showed you earlier, with the bottom end as well. The bottom end being the shorter trading periods of 1 day at a time with the FTSE 100, because some of us want to trade the short end, some of us also want to have the long end and do both ends. So with this, the rule that I tend to have with buy, hold, and forget for a 12-month period to get a 20% return is, after I've filtered them, if any one of them in that 12-month period drops 25%, automatically I sell that one stock and hold cash in that stock. That's it. The idea with this is to be as simple as possible, not faff around with lots and lots of rules or anything else, just these. Just these. And so when I went through these, that's what I've got to put through. Now, these won't necessarily change week to week, day to day. So some of you may have seen some of these names before, but what I'm updating for this week is coming up in a second. So these won't change because these are for 12-month holdings. They're not going to change day to day. So that's, I just wanted to recap. But what I want to give you now is something bang up to date, right up to now, which is some of the biggest questions that I've been getting, which are about these issues and some more as well. People have been asking about the fall off in gold, a little bit of a jump up again, and what does that mean? What do you got to remember? What does that mean for the global economy? What does it mean for UK and UK equities? Is it something we should be worried about? Should we panic that if gold is falling off a cliff? Well, actually, no. Gold outperforms during a banking crisis. When gold, and statistically that's shown to be the case, whenever we perceive there to be a banking crisis like the credit crunch, gold tends to outperform. When there isn't a banking crisis, it does pretty poorly. So at the moment, it's quite clear that we don't perceive ourselves to be in a banking crisis because gold is falling off a cliff. Given that we don't consider ourselves to be in a banking crisis, that's good for equities because equities perform the best when we don't perceive ourselves to be in a banking crisis or any kind of crisis. So the fact that gold's falling off is actually very good news for equities. Okay, that's the first thing. The second thing that's still been coming up, people complaining about Apple and how it's been not doing so well. Does that mean that the broader market is pretty poor? No, not at all. Apple's issues relate to itself. I still think it's a pretty good stock because on a discount cash flow basis, they're still generating lots and lots of free cash flow. It's just that the expectations haven't been met recently, and that's why it's fallen off. So that doesn't tell me anything negative about the UK economy. But that raises a better point, which is how come the FTSE has been rising so much given the equity, the debt situation in the government, so much negative news, and should we be worried? This is what people really want to know about. Should I even be holding equities given how much negative news there is in the broader markets? Once again, no. And the reason for this is this. I was explaining to a colleague and friend from Deutsche Bank earlier today. You see, what's happening with the markets at the moment, why they're rising, is this. Earnings expectations are incredibly low. Expectations generally with the equity markets are low. The reason expectations are low is because we keep on hearing about negative news about managing debt and so on. So you might say they're rightly low. It doesn't matter why they're low. The fact of the matter is expectations are low. Yet, global growth, thanks to new markets opening up, has been pretty good. So earnings have been relatively strong. That means that expectations have been exceeded. The only thing that moves stock prices is when expectations are exceeded. Expectations have been exceeded because they're so low and because earnings have been able to be maintained through global growth. That situation will not change in the foreseeable future of up to the end of this calendar year. That is why I'm not worried about equities at all. Earnings keep on exceeding expectations. Expectations keep on being low. In other words, perversely, all this negative news is actually good for equity markets. Of course it's perverse. Of course it's counterintuitive. If it wasn't counterintuitive, everybody would always find the markets incredibly easy. But that's clearly what's happening. It's not a relief rally. That's something different. This is more sustainable. Why are earnings so strong then? Because people are saying, wait a minute, there's all this debt. How can earnings be so strong? The reason earnings are so strong is this. Look at the three sources from which any amount of earnings can be earned. They can be earned from government spending. Well, despite even the austerity drive in Britain, government spending has actually been increasing. Yes, I know the disability rules which have kicked in today, for instance, mean that certain parts of the government spending have been cut. But across the whole, our debt is actually increasing. Our spending, one way or another, whether we like it or not, is increasing. Okay, and I'll come to the issue of QE boosting stocks as well, Stephen, in a second. So government spending is up. That means that's good for contracts. I can tell you defense contracts are certainly up. That's one thing. The second thing then is, what are the other two sources of spending? Well, one is company investment. One thing we know about companies is they've been hoarding cash, and they can only hoard for so long, and then they've got to invest in patents and R&D and so on, which they're doing. And the third thing is consumers. Well, consumers are paying record low interest rates on pretty much anywhere across whatever you look at. So between consumers, government, and corporate investment, you're seeing money around the system. That has meant, because you're seeing money around the system, that has meant that earnings are keeping up. But not just that, as I say, global markets, Brazil, China, are helping boost British companies in the FTSE 100, which is largely an outward-looking index. It's a global index. How does quantitative easing work? I'm going to give you an absolute basic guide. Most people don't know how quantitative easing works. Quantitative easing is really simple. Let me give you the simplest way it works. Basically, the government buys a whole load of bonds from banks. Whenever bonds are bought, the way bonds work is whenever you buy them, their price goes up and their yields go down. In other words, the interest they pay goes down. When their interest goes down, it doesn't make much sense holding bonds, because if you're Mr. XYZ and you hold bonds, it doesn't make much sense holding lower interest paying bonds. Because you're getting very little return. You're getting the same kind of return you get in a bank account. So you then start looking for other homes for your money, like stocks. That's the whole point of quantitative easing. It is supposed to make riskier assets more attractive rather than safe ones. Why do you do quantitative easing? Because quantitative easing you do at a time when everybody's flying towards safety. So what you do is you make safety even more dull, so dull that people start wanting to go into risk. That's how equity markets get boosted. The other thing is, in nominal terms, all that extra capital entering into the system, because these banks now get given cash in exchange for the government buying their bonds, their banks are supposed to inject that cash into loans to businesses who then hire employees, who then have more money to spend, and so on and so forth. Means we should get some kind of a pickup in inflation, i.e. nominal prices, and the FTSE 100, of course, in nominal prices should start rising, so we get that wealth effect, that feeling of, it's going up. All of these things mean that I'm buoyant on equities. Like I said, I'm not trying to sell you a fund or brokerage service or anything else. I'm just telling you the way the analysis is. Don't just take my word for it. Goldman Sachs, luckily for them, agree with me as well. What about China? People have said to me, well, Chinese growth is slowing. Make no mistake, the Chinese control growth because they don't want inflation to get rampant. Why are they more concerned about inflation than we are in the West? Because inflation in China, in a communist-controlled economy, means social unrest. They can't abide social unrest. It's just the nature of the political system. China can control that growth like a tap because they're so good at controlling their economy. Recession, well, as you know, 0.3% GDP growth was announced last week. Are we in a recession? Technically not. However, this is what's really important and interesting. Whilst we're not in a recession, several polls which have been done strongly suggest that people feel they're in a recession. They actually wrongly feel that they are in a recession. Oddly enough, they actually feel they are in a recession, therefore not spending. That has been an odd effect for the equity market. First of all, it's meant that our expectations of earnings generally have been low. It's also meant that the consumer hasn't flooded to the market, but has been dribbling through in bit by bit by bit, as of course, sooner or later, they get forced into spending. Now, I know retail high street is in trouble, but it's largely in trouble because of spending moving online rather than spending being cut outright. Of course, there's been some cut in spending, but it's really the shift to online which has been critical. So the perception of recession perversely has been helping the equity markets because expectations have been set so low. I didn't make up the rules. I think it's daft that it should be like that, but that's not what I care about. I just care about making money from the markets, and that's what we're going to talk about this evening. I don't care if people are irrational, feeling that there's a recession and therefore the stock market rises. It's just how it happens. What about the American markets? Well, you've seen with the American markets, they are absolutely obsessed about growth in the same way the Chinese are obsessed about inflation. For the Americans, growth is a drug, and therefore they will do whatever it takes to ensure that growth, and they have been seeing growth. Even if it means the government is the chief employer, the government is helicoptering money to create jobs, none of that matters as long as they get some GDP growth. Even if the quality of growth is poor quality, we're not politicians here tonight, we're just here to make money in the market, so we don't care. One of the questions is QE4 likely? Well, excuse me, QE4 is actually irrelevant in many ways, and I'll tell you why. As you'll have seen from a lot of the data, it's having further quantitative easing is having a diminishing marginal return effect upon the markets. So it's become irrelevant. Is it likely? Well, it's a nice debate, an issue for politicians, but the reality of the situation is it almost doesn't matter, because what we're going to look at is how do we trade the FTSE in the markets, whether or not it's going to happen. So I don't know. I could tell you, toss a coin whether it's going to happen or not. And I suspect they've gone so far down the chain that it probably will happen, but it won't really matter for the FTSE and for the US markets. They're already on a rise up for the rest of this year. There's a roller coaster which is in place. And the thing that I'm seeing from businesses, and one of the things I do, as you'll see later in this presentation, for the UK government is look for angel investments from foreign companies setting up in the United Kingdom. And that gives me a really good ground level view up to see if there is or what level of entrepreneurial activity is going on and how that might feed into GDP and so on. One thing I can tell you is companies are looking to invest. I'm just seeing more of that activity than I have seen at any point in the last 5 to 6 years. And I see that ground up, companies looking to invest. And as I say, I'm going to mention this later on so you can all get an idea of the sources of data and the information where I get it from. And the information I get, I should say, comes from various sources like Goldman Sachs. Rothschilds are the bankers to my private equity fund, and ABN AMRO send me stuff, Barclays send me stuff, all these companies, and my job is to go through that. I should say this is not just a repeat of what I've gone through before, because obviously we've had time since the markets have moved on. What about Europe? Europe is still giving us no cause for concern. Now you might think, well, you're crazy, Alpesh. How can Europe not be giving us cause for concern? Well, actually, the reason Europe isn't giving me cause for concern is simply this. We are continuing to see the European politicians in unison saying we will do whatever it takes to maintain government debt at relatively low levels. Government debt payments, I should say. Therefore, they're keeping the cost of servicing debt low. By keeping the cost of servicing debt low, what you're seeing is that the governments are not causing a negative spook to the equity markets. And that's fantastic. That's great news for us, because it means that under that benign condition, the equity markets, as I said earlier, can continue rising, can continue going up. And I said the names that I like, and these don't change week to week, of course, are these for a 12-month holding period. These out of the FTSE 100. I've circled in red the least, the best valued, I should say. And more broadly, this is an indication. The slide that you see at the moment on screen is the FTSE 100 with the indicator arrows is an indication of how we are seeing things moving, which essentially I can summarize as this. Buy on dips, because we're going to get short-term movements down over the next 1 to 3 months. Buy on those dips, because to the end of the year we'll continue seeing prices rising in the FTSE. And what I want to do now is focus more on this, which is, okay, well, how do we trade it? Regardless of all the fundamentals that I've told you and the equity names that I've given you that I like the best out of the FTSE 100 and the best out of the rest that I like over a longer term period, how do we do this trading? Because people ask me for this training. And what I've done is I've changed it slightly from, I've taken the feedback from previous presentations. Some of you may have seen my previous presentation where I talk about understanding FTSE, and I've taken the feedback to make it even better in terms of explaining that. So that's what I want to do now, is explain how we're going to trade those short-term periods in the FTSE 100, maybe from everything from 10-minute charts all the way up to daily and weekly ones, because people keep asking, okay, show us, regardless of the fundamentals in the news, how are we going to know when to get in and get out for that longer-term period. So let me go through that. As I always say, trading is ABC. Money management, which I want to explain this evening for profits. Trading system, which is incredibly important, and trading psychology as well. We're going to touch all three. Get all three right, you've got profits. And our aim is really simple. For anybody who's forgotten what our aim is, doesn't understand what our aim is, our aim is simply this. We want, where you see the blue arrow and the entry marked, we want to be able to enter at that point. We want to know when to exit, so we profit from falling markets as well. Remember, one of the key things I said was that we're going to continue seeing over the next, say, month to 3 months, some downward movements and downward pressure in the FTSE, but towards the end of the year, longer, we're going to end up higher than we are at the moment. For all those reasons, one of the most important critical things is we ought to be able, and we ought to know how to profit, how to profit from falling markets. And what I've shown you here is 25th March, for instance, recent chart, where over a 1.5 hour period, how do we know with the FTSE 100 1-minute chart, each one of these bars is a minute, so they represent 1 minute and the price movements in that minute. How do we know to short there, to sell, so that we can buy back cheaper and make, as in this case, 24 points at £25 a point, or whatever pounds per point you want. It could be £1 a point you might have done, or you might have done £100 a point, and we'll work out how to do bet sizing in a second, so we make that 600. This is critical for us, given all that I've said up till now. Because what I've said up till now is I've given you the stock names for the end of the calendar year and for 12-month periods, but given that the market might be falling, and well, I think it is going to be falling in the shorter term, and it's an opportunity to buy on the dips, how do we profit from those falls in the shorter term? Another simple example, what I've just said, it's not just about the falls, but what about the rises as well? Can we profit from those rises? In this case, a 13-day rise in the FTSE 100, where we got the entry marked. How do we get those entries? How do we get those exits marked? And thereafter, having got those, how do we capture those 153 points and set profits so that we do make that 6,000 or so on, rather than just holding on? How do we do it with relatively small amounts of capital? If it's a leveraged product, which is what we're looking at here, how do we do that in a short space of time, and how do we manage the risk? Because not every trade will be winning. How do we manage the risk? And I want to get that education over to people. It's vitally important, because the opportunity which exists varies from week to week, year to year, month to month, week to week, and so on. And I want to get this across now, because I think, given what I've said about the markets rising at the back end but falling in the near term, means we've got the opportunity to make money as they fall, and of course make money as they rise, rather than just buying and holding. I think there's far more to be made than there is just buying and holding. And for the sake of another 40 minutes of education, you can get a grip on exactly how to do that. That's what I want to get across. So what's tonight about? Now, I'm going to recap this. Some of you will have heard me say this again, but it's worth listening to again. I want you to trade like a pro, even if you're new to all of this. I want you to know that trading should be as easy as ABC. I want you to learn how to sustain long-term profits. I want you to understand exactly, precisely how and when to trade. And you should have a way of killing your loss-making trades. I want to show you how I turn loss-making apprentices into profitable traders. That's what tonight's about as well. And I want you to have my best trading methods. And I'm reiterating them because a lot of people don't actually get it first time round, and it does take a repeat of the class or so on. But I've got some additional material that I want to give you to make it even easier for people as well. So what are we going to be learning? We're going to make sure you're not one of those 80% who lose. Why people lose 50% of their money trading in year one. We're going to get that across as well. Why does that happen? How do we make sure we're not one of them? How do we make trading stress-free? It's one of the biggest things I keep getting asked. It's stressful, it's a roller coaster ride. It's not supposed to be. You're doing it wrong if it's stressful. That's the point. You're doing it wrong if it's stressful. And my job is to make sure it isn't. And I'm going to show you how tonight, because when you've got a straightforward system, then it is. Anil, is this live, Alpesh? Yes, it is live. The next question you're going to ask is it Alpesh? I'll show you my birthmark later on. Be certain in all your trading decisions, and also not getting ripped off on automated trading systems as well, and get on with profitable trading. So this is, again, just a reminder what we're looking at. This is what we've got to try and achieve in those short-term periods as well. UK 100 5-minute charts. How do we capture those gains? The thing with education is, remember when maths, when we were at school and we had to keep on solving the same problems over and over again until it became second nature? Trading is no different. You've got to practice it until it becomes second nature. And that's why I say to people, go through my materials over and over again until it becomes second nature. I didn't just pick it up in an afternoon or in a 1-hour webinar or so. It took me going through it over and over again, having the discipline to do it 2 or 3 times, and then it becomes second nature, and then just continuously doing it so that we keep on understanding it. Yeah. For instance, here you've got 5-minute chart, £25 a point, 41 points, £975 profit. 5 hours. How do we get that? You really need to understand momentum. You need to understand the psychology of trading as well. Now, very quickly, for those who don't know who I am, I'll run through this in just a couple of seconds. Author of 16 books, as you can see, everything from barrister to asset manager, writing columns for the Financial Times, books, presenting for Bloomberg as well. This is actually very relevant to what I'm going to explain with my trading systems, because what's critical is for people to understand. The ability to explain it clearly is what leads you to outsell Harry Potter and so on. That's why I say to people, it's important how things are explained, not just what's explained. And from my offices, it means I can tap into the global markets. And that's what we can do from home now, and that's the point of doing webinars. You can all tap into the global markets. Yes, I know, 16 books in 8 languages, I should say. And key expertise is in trading strategy and in education, which I'll explain in a second what those exact areas are. Some of the paying clients, I should say, are these companies and the names that you see on screen there. And those are the channels. So I'm going to go through the bio really quickly because I know some of you will be very familiar with it. And you see me on all the various channels as well that you'd expect. But one of the things that I want to get across is it's vitally important also in understanding the market to be an industry expert on it. You can't understand the market and not be considered an industry expert and a global expert on it. And what I want to get across this evening is the strategies that I'm looking to apply whether you're tuning in from Australia or from Canada. The point is I try and pick strategies which are globally relevant. And the reason for that is we want markets which the world trades, because with liquidity comes smoother price moves, bigger price moves, and that means more profitability. You do something very, very niche, and you're going to get whipsawed and you're going to get whacked out by some big fish who comes in and moves the whole market against you, and you're going to be outmaneuvered. What I want to teach you this evening is the system strategy which got me to this in the Financial Times, where they call me the top FTSE 100 forecaster and was ranked #1 by them. That's what I want to get across to you. And the reason to teach people this is the same reason the dragons teach information, is because if you can learn it, then and you'll see one of the emails that I got earlier today later on, it becomes incredibly fulfilling as a practice. Trading is just phenomenal as a practice once you've taken on the skills and decided this is what you want to do. Two trades I want to show you. The FTSE 100 30-minute charts tend to be my favorite. 30 and 60-minute charts, actually. I just find they fit in with the number of trades I get, and the smoothness of entry signals tend to work the best for me and my mindset. Some like daily charts, some like 5-minute ones. That's fine. I like the 30-minute and 60-minute. And here you can see number one is marked in blue, and what that trade was, and the profits from those. And you can see number two. This is what we want to try and keep on replicating all the time. Not all our trades are going to be profitable, obviously. Obviously not. So one of the things I've got to focus on is, how do we make sure our losses are relatively small? How do we make sure that our losses are actually negligible? Yeah, that's one of the key things I've got to get across, because not all trades are profitable. I'm going to show you how we professional hedge fund managers do that. But the first thing I've got to keep on getting across to people, I have to keep on explaining to them, is how do we make sure we get winning trades like this? What is it that professional traders do that we private investors can replicate? And like I told you earlier, for those who doubted about the trading strategies, this is my first book in Financial Times, or the publishers, Mind of a Trader, where the chairman of the world's largest derivatives exchange explained that the methodologies are those of successful traders, and I capture it and get it across. And that's what I want to get across to people. Thanks to technology, which didn't exist when this book was published, I can now reach hundreds of you online around the world than we ever could before. And that's phenomenal. That's absolutely phenomenal. I'll have more books coming out at the end of the year, such that these strategies can then be used. And these are all client companies as well of my company, whose clients I teach on trading. Okay, so you get all sorts of other businesses asking you to assist and help and so on, their clients as well. And you see some of the logos of those. Right. So what we want to know is, okay, well, that gets you the good stuff, like Barclays ask you for your opinion, and I want to teach you the methodology which gets you all of this. Well, I show people. I'm not showing people just to say, hey, aren't I great? But the reason I do it is because learning how to trade properly gets you all of this, because if you're accurate, then the magazines start shoving you on front pages. They don't just do that because I tell them to do it. They do it because this accuracy can be learnt, and that's what I want to teach people. I put it into my books. I want to put it into the webinar and have you learn it, because it'll be incredibly rewarding for you as much as it is for me. So you keep seeing the magazines who keep on then having this. You saw the FTSE 100, the Financial Times earlier as well, and I want to teach that level of accuracy because I know it can be taught. Investors Week as well, and the front cover of that magazine. And as I say, various other brands then want to have the name associated with it. So how do we get the buy rule, the sell rule, and the minimize my risk rule? Okay, and while I show you all of the sort of accolades that you get by getting those three things right. What's the buy rule? What's the sell rule? What's the minimize my loss rule? Get those three things right. And I know I'm making it sound a lot easier than it is, but that's what this evening's focused on. And I'm going to give you those rules. I'm going to give you them, and then I'm going to give you a method in which to make your life even easier. My point is then to get that across. So there's a reason why I'm explaining that we have all of this and then inventing the software and so on, which is to lead up to this. What is the buy, the sell rule? Okay? And it's this. I prefer momentum trading, and that's what we're going to talk about. That's the most important thing for me. And the reason I like momentum trading is because it allows you to build up in scale, to go from a one-man band into an asset manager, or one man running into getting other people such as yourselves who are on here to learn and replicate it in the same way an apprentice might or a dragon might teach people. It's exactly the same principles that we do. This is the stuff I want to teach, okay, this evening, is getting those losses, because they can't all be wins, and you can see on the left-hand corner there's a little smiley face, says you cannot win them all. How do we make sure those are minimized, and how do we make sure that the other bits, the movements upwards, are captured? How do we make sure those are captured, that we get by and so we get at the bottom of a trend and upwards of a trend? What is it about the nature of a trend that allows us to be able to forecast it, to predict it, so that we could get the profits that you can see on screen? £40 a pip. If it was 1,480, you might do £10 a pip, you might do 100, as I say. So how do we go around doing that? Okay, it starts off with trading strategy, not a problem for me. Starts off with computers. Well, we've all got those now as well. That makes life really easy for us, and it's because we all want to avoid hard work. That's why we're all here. Nobody wants to work incredibly hard. I want to avoid a paper round. That's why I did it, and started off with the investing in the stock market, and which then helps us pay for whatever things that we need to pay. Moving on from the bar, basically trading was more lucrative than any other method that I could find, because you're buying in stocks like Next. You can see Next, and when I left the bar in 94, you can see the rise up, and things just keep rising. It's a lot easier making money by following trends than it is, well, working for a living. And so first thing that came about was getting the Financial Times to see how good the forecasts were and the strategies were. And that's my first book, Lessons in Trading Strategy, and that's what I'm going to discuss this evening, Lessons in Trading Strategy from the world's leading traders. One of the world's leading traders that I want to teach you on the aspects I'm going to mention this evening, Bill Lipschutz. It's important you know the pedigree of all of this, for the simple reason, if I just give you the buy and sell rules, you're going to think, well, is it really any good? Whereas this way, you know the pedigree of it. So Bill Lipschutz is in my first book, The Mind of a Trader. He was at Salomon Smith Barney as global head of foreign exchange when Warren Buffett was the chairman. It's a pretty good pedigree, okay, published by the FT over there. So I want to give you in a webinar tonight what I learned that worked, and that allowed me to discover my dream, which is opening an asset management company. I copied what I was taught by the world's leading traders in trading strategy and set up an asset manager, and I can teach that. And that's what I'm going to do this evening. Because what I want to teach you is, how do we do momentum trading? Why do I like it? Because it's like this. See the blue arrows? That's where we want to be long. The red arrows, ideally, is where we want to be short and want to profit from long and short, long and short. The reason we want to do that, many of you will know this, because if we just did buy and hold, which is what the green arrow shows, we end up with nothing at the end of it. Whereas we do that more active trading, then we end up with far more profits on each leg. How do we do that? The other great thing about it is it's less risk, because you're in and out of the market. You're not exposed to it long term in case of a massive crash or anything else. And we no longer need to be at banks either. That's the great thing, because we've got all that information in front of us online. Thanks to automation and using computers, as I showed you earlier, we've got the freedom then also to smell the roses. And that was my motivation behind all this. Also, one of the other things was I just didn't want to read the news all the time, just be constantly bombarded by it and try and second guess the market. So I did momentum trading and set up the buy rule, the sell rule, and the how to limit my loss rule. Those three things were the critical things, because for me, it wasn't just about making money myself. It was, as I said earlier, to go from a one-man band to create an institution. And you can see here another momentum trading institution, which is my role model, Winton Capital, and they're shown in blue, whereas the S&P 500 is shown in orange, and that's how most people perform, is in orange. What we do is go for that blue line and get that momentum trading type of results, those aspirational firms we can follow. So why the FTSE 100? Why have buy and sell rules and limit losses on the FTSE 100. Really simple. Large and liquid, so very difficult to manipulate, if at all. Large and liquid, so tight bid-ask spreads. In other words, the difference between buy and sell is at worst 2 pips. Normally, it's 1 pip, 1 point. That's it. Large intraday price swings, so lots of opportunities to make profits. Also, low initial capital requirements. Don't need much money to set off. I'll explain how much money in a second. Also, lower risk than buying and holding stocks. A lot lower risk than buying and holding stocks because you've got a whole index instead. And that means that there's less risk. And it's just as easy as I showed you earlier to short as well as go long. You only have to study one index instead of hundreds of stocks. I gave you the names of stocks at the start of this presentation and how I'd gone through all of them and analyzed them for you in terms of valuation and so on. The benefit here, of course, is that you don't actually have to do any of that with an index because you're only looking at the index. And there's no commission to pay. Most brokers, if not all of them, will charge you nothing to trade the FTSE 100 index. I like that. No commissions. Daily, the FTSE 100 future is 8 a.m. till 9 p.m. That would mean most people can trade that either around their day jobs or actually in the evening. You can trade it even on a 5-minute chart and do some trades there. Low entry barriers. The platforms are free. Free platforms. Okay, free platforms, no commissions, 1 pip spreads. No wonder I like the FTSE 100. But we still, therefore, need to know the buy rule, sell rule, and how to limit losses. Okay, how do we do that? First of all, we're going to use technology to make sure that we don't have to keep on looking at news and so on. That was the first thing. We've got to use the latest technology to stay ahead of the game so we can implement our buy and sell rules. We've got to access the FTSE 100 using that technology so that we can trade it instantly at no cost. We don't want any commissions and we want free platforms because this is probably one of the most important slides I'm going to show you, and let me explain this. Even if you've seen it before, it's really important to understand. If you put together the 100 random trades of the world's leading hedge fund managers, and this is exactly what I saw with people like Bill Lipschutz, the global head of foreign exchange at Salomons, and all the hedge fund managers that I know, and including in our own fund. This is what it would look like. The number of trades out of 100 which were big losses would be none. No big losses. And I've got to therefore show you how to make sure we get no big losses because we want to replicate the best. It's really simple. If you want to be the best, you've got to replicate the best. It's not rocket science. The next thing is there would be, of course, lots of small losses. Small is what's critical. Small because you're not going to be right 100% of the time. There's going to be lots of small wins because if there were only ever big wins, you'd only need to be in the market for a week and you'd be laughing. Okay, so there's going to be lots of small wins and there's going to be a few big wins. How do we make sure we get big wins and no big losses? That was critical. That's what I learned from the world's leading traders. It's what every hedge fund does. If you can get your hands on any professional trader's performance, this is what it looks like. George Soros's looks exactly like this as well. If you buy the book Alchemy of Finance, look in the back, you will see it's exactly he has a trading diary. It's exactly what's replicated. No big losses, a few very big wins, which I'm going to teach you tonight exactly how we professional traders do it, and the rest are just small losses and small wins. If you think about it logically, rationally, that's of course going to be the case. It's of course going to be the case for what winners look like. Guess what happens with private investors? This is inverted. They have no big wins, a few big losses which wipe them out, and the rest just go around there. So, realization number 4, which I want us to implement, is trading tools allow us to save time. And that's what we're going to do. Latest innovations to save time on the markets. And we know private investors can do it. This is the chart that I always like to show. This little image I like to show people. We know private investors can do it. Before I give you the buy, sell, and how to stop losses rules, the 3 rules, we know private investors can do it because I see things like this where over a 12-month period last year, profits recorded by top trader from a particular broker. I'm not endorsing a broker here, just was £1 million, and you see the averages of the next 10 and so on. Some amazing, phenomenal figures that we keep seeing of the kinds of performances that traders, private investors like you are doing. So how can we do that? What are the buy, sell, and reduce our losses rules? First thing we've got to be familiar with is any trading platform. All trading platforms, easy as ABC. This is a free one, which I'll show you later how to get hold of. A is where the symbols are, and that's where the UK 100 would be, which is the FTSE 100. B is the chart. Now, this is what we're going to focus on to get our entry and exit rules and our loss limiting rules. And C is just the time frame. So what we would get is free trading platform, which I'll show you where to get hold of free trading platforms. Extended hours trading opportunities, like I said, 8 a.m. till 9 p.m. That's important for us because if the markets are not open, we're stuffed. We can't trade. No commissions. That's important because these costs eat into us. Okay. Then it's simple. We pick the time frame. We pick the entry. We buy and sell. So the next thing becomes, how do we know when to buy? How do we know when to sell? This is what I've got to explain to you now, because it's all been used for decades. It's been used for decades and decades and decades by all of these firms. Use momentum trading, the type of trading that I've just been talking about and I'm about to explain to you. It's all well known, and every single one of these uses momentum trading. So what is it that the nature of it makes sure that we get a few big wins and no big losses? Okay, the basics you're all familiar with, what the open, high, low, close bar looks like. What I've got to build you up to is giving you the buy rule, the sell rule, and how to limit our losses rule. Okay? This is what a buy looks like. How does momentum trading work? Well, it's about following the trend. We get a buy signal at the start of a trend, obviously. The start of a trend, and then we get an exit and a sell. So how do we know when a trend is going to start? How do we know that? How can we have rules which tell you the direction a price will move? The essence of this, of all momentum trading, is that when prices close near their highs, it suggests there's momentum in the market. Of course it does. Again, it's logic. If they didn't close near their high, of course there isn't momentum. There's so much demand, they close near their highs. So they don't just rise, but they close near their highs. Now, that's not enough for us to determine a buy rule. And also, who's going to go around with a magnifying glass looking whether or not the FTSE 100 on a 30-minute chart has closed near its high every 30 minutes? We need the computers to take the pressure off us, as I explained earlier. So it's not just prices rise, but they close near the high for each period. Also, how do we identify a stall in momentum? Well, we know momentum's about to stall, i.e. trends are about to change direction and the market about to fall when prices start closing near their lows. So let me explain how that means. Imagine this on day one or period one, if it's a 5-minute chart, the price has closed near its high. Period 2, what's happened is, on day 2, what's there happened, have a look at that, the price has actually risen, but the price has closed near its low. Price has risen from one period to the next, but it's closed near its low. That tells us that momentum is slowing. It's telling us that even though the price is going up, now's the time we should be looking to get out. That avoids us getting out when the market's already fallen and it's too late to get out. We're trying to get the start of a trend and the end of a trend. But then that begs the question, how do you measure the strength of momentum? Well, you measure it by how close to the high the price closes during that period. Like I said, you're not going to use a magnifying glass to do that. We want computing power to do that. The sad thing is nobody actually ever explains to private investors that all this technology exists for them to be able to do it. Nobody ever goes into it. And that's why I think it's really important, just as when you were at school, that the best students were the ones who understood the background thinking to something. Now, I use the MACD, which many of you have heard of, but I use it very differently to any of the textbooks to get my buy and sell rule, which I'll give you in a second. I use the MACD, and for those who want to know, and you don't need to know how it works and how it's calculated because it's free and it's available on most pieces of software, so you're not buying anything to use the MACD, but the rules I'm going to give you are different to you find in any textbook. By the way, the rules I'm going to show, the calculation for the MACD is on screen. You don't need to worry about it. It's a complicated calculation. All you need to know is, well, what are the, just like you don't need to know how a TV works to enjoy it. What are the rules for buying and selling and limiting our losses that I've created through experience, which have been on the charts that I've showed you in the profits and have picked the trends and provided momentum trading, which provides the profits, which all those hedge fund managers also use that I derive from them. So a rising, this is the rules now, so get the pen and papers ready. A rising MACD tells us, of course, a trend will continue. We're familiar with that rule. But actually the textbooks are quite wrong. They use it in the wrong way, or they use it so prevalently that it no longer works in that way. That's why we've got to be slightly smarter than everyone else. This, what I want to show you, just some definitional points. This is the MACD indicator starting to rise, showing that price momentum will rise as well. Okay, it's the red line starting to rise. That's what I mean by starting to rise. It's just rising. Okay, just definitional terms for the moment before I give you the buy and sell rules, which once you get used to, once you listen to this a few times, you get used to, it becomes second nature. It's just that the first few times, just like when you started doing calculus or algebra or trigonometry for the first time, it was like, oh my God, that's complicated. After a while, it was like, wow, this is phenomenal. This is so easy. The answers just come out the other end. And then we move on to, instead of doing it as mental arithmetic with pen and paper, we start using computers or calculators, and it becomes even easier. But I need to explain it to you. Take the trouble to understand it, and then it's with you for the rest of your life. So this is the MACD starting to rise. That's what I mean, okay? I'm showing it on screen. Then I'm going to give you the specific buy and sell rules, and you'll see why they work, okay? Why momentum is rising, and therefore a trend is about to begin. And that's what we want, trends, okay? So what are the rules? Well, how I use it is this. It's time-tested custom modifications to the MACD. You don't need to change anything to the software, actually, or any software you have for using the MACD. And it's been perfected over long periods of time. That's why I'm entrusting it. I just want you to know it's not just something which came up on a whim, and then I'm foisting it on you for fun. So this is the buy signal, okay? This is the buy signal. What it means is there's a buy signal when the momentum in this time frame. Now I'm using here, the example I'm giving, doesn't matter what time frame, because whatever time frame we're trading, the rules are the same for that time frame. This happens to be 4-hour charts. It could be daily or whatever, as long as whatever we're trading, because we might want to trade 4-hour charts because we want more signals than on a weekly chart, for instance. Okay, momentum in this and the next time frame is not negative. By that, what I mean is the momentum is flat or rising in this time frame, which is the 4-hour, and the next. What do I mean by next time frame? Well, if you're looking at the 4-hour chart, the next time frame, I mean, is daily. If you're looking at the 5-minute chart, because you're sitting in front of your computer all day and you don't have a day job other than full-time trading, then the next time frame is 10 minutes. If it's the 10-minute chart, then it's the 15-minute. And if it's the daily, because you're on a day job and it's very busy. By the way, if you're in a day job, then the 4-hour charts are absolutely ideal for you, because the number of signals that you get is not every 4 hours, of course, but they happen at a sufficient frequency that even outside during a day job, you come home, you can check it, and every 2 or 3 days you get a signal. So if it's daily, then the next time frame is weekly. And what you make sure, this is important, what you make sure is that the momentum in this, and I'm going to go through all of this again, is not negative. Momentum is rising, not just in this time frame, but the further out time frame. Why? Because money that moves the market more strongly is not just money which is looking at your time frame, but is the longer term time. It's like tides on a shore. The biggest waves are when the ones which are coming in frequently tie in with the longer term waves coming in. It's the same principle with waves of money coming into the markets and market momentum. It's reinforced. Anybody who knows anything about acoustics and sound, it's the same principles that occur. Reinforcement leads to bigger moves. So if this time frame and the next time frame momentum is not negative, you're going to get a bigger move, a more likelihood of a trend, a higher probability trade than otherwise. Okay, and you can see the MACD is not negative in this time frame, and in the next time frame wouldn't be. Okay, the next thing you do is you only buy when the price in the next period moves above the high of the past two periods. Now, let me explain that in English, because oh, and somebody's asked, if you're looking at 30 minutes, do you check the 1 hour? Exactly right, Anil. Exactly, perfectly right. 30 minutes becomes 1 hour. 1 hour is 4 hour. Okay. So let me explain. You then, once you see in this time frame, so if you're looking at the 4 hour, for argument's sake, you're looking at the 4 hour, you wait for the price to make a 2-period high. I'll go through all this again, so don't worry. You wait for the price to make a 2-period high. Why would you wait for the price to make a 2-period high? It's incredibly important that you're led by price and not just by momentum moves alone, because price is the critical factor. And you can see that I've shown on screen that the price has made a 2-period high. As soon as it moves above the horizontal red line, which is on the screen there, as soon as it moves through that, not closes above it, but just moves through it, that's a 2-period high. That's your buy trigger. That's your buy trigger. Okay? So you had your momentum confirmed in this time frame and the next, and you had your 2-period high. This works because it's based on momentum. It's clever for the reasons I'm going to show you. And it's got nothing to do with the price close. Even if the price makes a high but closes near the low, that's fine. As long as it goes through that, we've found that time and time again, that's what happens. It keeps on confirming us that the trend is about to start every time it does that. I'm going to give you lots more examples because, like I said, with maths at school, it was the examples which really drilled it home to us, and it's worth taking the effort and the time to do it. Before I go back to the buy rules, let me just explain the sell rules. When to exit a trade, and then I'll explain how we make sure our losses are low and also how we get some of those big gains. How do we make those profits run as well? Okay, how do we do that? What you can see when it comes to exiting a trade is this. When the MACD is flat or falling in this and the next time frame, and the price makes a 2-period low, you exit half your position, and when it makes a 3-period low, you exit the other half. If it happens to just jump and make a 3-period low all in one go, then you exit 100% of your position in one go. Got it? So, and I'll answer more questions as we go on. So that's the exit. Now let me run through all that again and how we make sure our losses are kept minimal and how we ensure we get some big wins. In other words, how do we run our profits as well? Okay. So example 1. It's typical trade that results from the rules I gave you. Because next thing you want to know is, well, wait a minute, does this work? And then I'll explain why it works so much better than other systems. So you can evaluate any system, including whatever you're using at the moment. I'm going to show you a method of evaluating all systems so you can tell whether or not they're good. Example 1. This is it. Okay, this is an example of a trade which was done using the principles that I've shown you. And you can see the returns that were made as a result, where it got in, where it got out. Okay, the next question I get asked by people is, well, why 50-50? Simple reason for that. I found that's the optimal way in which to exit a trade. 2-period low, you get out half. 3-period low, you get out the other half. The reason is sometimes if it reverses, then at least you still own half. And if it drops even further, then at least you got out of half. Simple as that. That's all it is. Okay. So let me go through some examples and then run through the buy and sell rules again, and then run through the how to limit losses and how to run profits so that you've got all the components that a professional trader has in a system which gives them big wins, a few big wins, keeps losses small, and avoids all big losses. And I'll explain why this system is so good and how you evaluate all other systems, including your systems as well. Profit potential of momentum trading is shown here. UK 100, 5-minute chart, where you sell, where you buy, £10 a point, £310 in 3.5 hours. Now, some people are going to do £100 a point. Some are going to do £1 a point. How do we decide how much money? I'll show you in a second. But this is an example of how the rules I just gave you generated buy and sell signals. Okay, another example, UK 100 daily, entry 60.10, exit 63.05, spread was 2 pips, profit at £20 a pip, 5,860, 3 months to get those. Because here we're looking at the FTSE 100 or UK 100 daily. I'll show you where you get this free platform from anyway. It's a free platform, and as I said, we want free things. This is the daily. That's what the buy and sell rules that I just gave you, which I'll go through again, got us these. But it's not obviously all going to be winning trades. So how do we make sure our losses are minimized? That's come up to in a second. How do I develop this? How do we evaluate all systems? Well, obviously thousands of live trades, 20 years working with the world's leading trades. That's why I showed you my biog. It wasn't to promote myself. I do a newspaper review on the BBC with 220 million people, so I can assure you it's not to promote myself in front of several hundred in a private webinar. It was to explain the source of the strategies, because otherwise you might put them in the same category as anything else. 16 books on trading, working with top traders to improve this, as you've seen, and then keep on using it until you get to the front page of magazines, basically. And it's, again, not about self-promotion. My ego doesn't need more self-promotion. The point is, does it work? Why does it work? How do we know it works, Alpesh? How good is it? What proof is there that it's so good? What are your credentials for it? Those are all the things. Now, sometimes you get some very good purple periods of it working incredibly well, trade after trade after trade after trade. And I love that. I love that when that happens. It's great. It's phenomenal when that happens. Show you another example. The idea is with these rules, you can apply across any time frame. So sometimes it'll be the 1 hour that I might be looking at, FTSE 1 hour, FTSE 100 1 hour, and you can see examples. And you might say, well, why didn't it not get in earlier? I'll explain that. So where do other systems go wrong? Before I give you the buy and sell rules all over again so you understand it, which is how I'm going to do it, how do other systems go wrong and why is this so good? And also, how do we limit losses? How do we let profits run? ABC, again. Their entry with other systems is either too late or too early, so how come we're more timely? Their losses, stop losses, get hit too often and cost too much. So how do we make sure our stop losses don't get hit too often and don't cost us too much? That's the essence of a brilliant trader, by the way. And I'm not saying I'm a brilliant trader. All I'm telling you is, don't take my word for it. I'm just copying Bill Lipschutz's methods, and he is a brilliant trader. So I don't want people saying, well, how do we know you're brilliant? Well, you know what? I'm just giving you the best strategies of the best in the world, published by FT, no less. They do not know how to run profits. That's the problem with other systems. So what does running profits mean? How do we run profits with something like this? Okay, let's do that. ABC. Let's go through all of that. Where other systems go wrong? They either get in too early or they get in too late. Okay. Alpesh, well, why is yours so good at timing then? I'll explain why the methodology I've just explained to you is so good. Okay. And I have slightly different rules for FTSE 100 and FX, because the nature of foreign exchange is it tends to revert back and trades around a range. The FTSE can just keep on going in one direction. But the rules I'm giving you relate to the FTSE 100. I'll explain the tweaks a little later. Now, it's triple filtered. I call it the ACT filter, ACT filter, because I used to give it a different name, and then somebody in the audience said, actually, this is a better acronym. It's more catchy. So I've used this acronym, ACT. This is why we're timely with my market. This is why we're timely with this. Filter 1, A. Assess momentum, as I've explained with the buy rule, assess momentum to ensure consistent positive buy signals. Yeah? We assess the momentum first in this and the next time frame. That's the first thing we did. Filter 2 was we confirm momentum in the next time frame. So the first thing was we assessed momentum. Is it flat or rising? Next thing was we confirmed it on the next time frame. Is it flat or rising? And the third thing is we triggered only when we got a 2-period high. Act. Now, if you think about it, that's when we knew to act. If you think about it, all action is based on assessment, confirmation, and triggering. All action is, not just trading, all actions. All I've done is taken the logic of all actions and said, let's apply it to trading. Guess what? A lot of people just don't do that. They do it in other parts of their life, but they don't assess the situation, or if they do, they don't look for confirmation, so they end up taking poor probability trades, and then they either don't trigger because they're not sure, because they never did step 2. We assess it, we confirmed it, because we had momentum in a further out time. And then we triggered it only when we saw a 2-period high. What did it do for us? Well, it gave us starts of trends. But here's the other bit where other systems go wrong. And this is what's so good about ours. They get big losses. We don't. Why don't we get big losses? The nature of our methodology is that we get out when momentum is lost in either this or the next time frame. In either time frame is lost. Okay? We get out when momentum is lost in this or the next time frame, and the price makes a 2 or 3 period low. That makes sure our losses are small, because the nature of the system, it's embedded in the system. You're getting out pretty quickly. You're getting out pretty quickly. Because you're getting out pretty quickly, the beauty is your losses are small. But I'm going to show you another way in which losses are kept small as we progress. Okay, so our losses are small just by the nature of this. I wanted a system where my losses were small. All professional traders make sure losses are small. But Lipschutz told me this is how we do it. Not just him, all the traders, the world's leading traders I've ever interviewed and spoken for, ever interviewed for the Financial Times and so on, are all done. I should say I'm recording this, and I will send you an invite for the recording, but hang on for this for various reasons. The other aspect is trading psychology. We had to make sure our losses were kept small because people have a problem with taking losses, and that's why they end up getting big losses. You can either go long or you can go short. The rules for going long or short, by the way, are just in reverse for going short to the ones for going long. The other way in which we make sure our losses are kept small is we made sure that we never lost more than 1 to 2, at most 3% on any one trade. Now, ideally, what I'd say is never lose more than 1%. How do you make sure you don't lose more than 1%? Well, you've got to know how to size the bets. So you trade in a way where you know what your maximum loss will be, and that's not more than 1% of your trading capital. If your trading capital is $10,000, 1% of that is $100. You've got to make sure if it hits your stop loss, you don't lose more than $100. How do you set your stop loss so it doesn't keep on getting hit? We'll come to that. That's a clever little technique that professional traders use. And the reason we wanted to make sure those stop losses were never too big is because if you had 5 consecutive losing trades, why am I talking about 5 consecutive losing trades? We're supposed to be amazing and brilliant, aren't we? Hey, just look at George Soros' trading diary at the back of Alchemy of Finance, and you'll notice 50% of his trades are loss-making, actually slightly more than 50% of one of the world's billionaires is loss-making. So let's say you had 5 losing trades. Because you had 5 losing trades, and if you lost 2% on each, you're only down 10%. Guess why private investors aren't George Soros? Because if they have 5 losing trades, they're down about 50%. If you're down 50%, you got to double the money that you've got left in order to get to break even. So we've got to make sure we don't get those losses. How do we make sure we don't get those losses? Let me teach you probably the most important lesson you're ever going to learn on trading. I've given you the buy and sell rules. I said I'm going to teach you how to make sure your losses are kept small. Assume you have a stop loss of 40 pips. I'll explain to you in a second how we come to a figure of 40 pips or whatever it is. This is so incredibly important. I've written about this in the FT. People just don't bother learning this stuff. And this is the stuff that comes from all the professional hedge fund managers. I didn't invent this, by the way. I wish I invented how to keep your losses small bit. No, I didn't. Some of the biggest billionaire hedge fund managers in the world did. Not private investors. Not private investors. Billionaires invented this little rule that I'm going to give you. Okay? It's just that private investors refuse to apply it. And that's why I give webinars, because they just refuse to do this stuff. Anyway, risk management explained. Assume you have a 40 pip stop loss. And as I said, I'll explain how you get to 40 pips in a second. Then that should equal 2% of our risk capital. Ideally, it should be 1%, but let's say it was 2% of our risk capital. Okay? If our risk capital is £100,000, just to keep the numbers easy, okay, for you it might be £10,000. Fine, we'll just divide everything by 10. Then 2% of 100,000 is, of course, £2,000. Okay? Therefore, 40 pip stop loss should equal £2,000. Obviously, that's just logic. Yeah, got it. Just got to make sure everybody sees that on screen. So 1 pip should be £50. £50 a pip, 40 pips, £2,000. So if your stop loss was 40 pips, and how do we get to 40 pips? I'll explain. If your stop loss is 40 pips, we shouldn't lose more than £2,000 because that's 2% of our risk capital, and we don't want to lose more than 2% of our risk capital. So if a 1-lot contract is £10 a point, then we want 5 lots. In spread bet language, £50 per pip is our bet. £50 per pip, 40 pips, 2,000. Got it? That's fine. That's the bet size based on our initial capital. But how do we know what our stop loss is? How do we know that it's 40 pips? How do we decide that? That's what's the next thing. Well, the way I decide stop losses, that it should only be 40 pips or whatever, is I set an initial stop loss, which is fixed, not trailing. Fixed, not trailing. Fixed, not trailing. Fixed stop loss, initial entry, when I get my entry, which is twice the average range that the price is moving in any given period. So if in a 5-minute period it tends to move about 5 points, then 10 points from my buy point is my stop loss. If it's a 30-minute chart or a 1-hour chart, it might be 20 points is how much it moves in each hour on average, roughly by eye, because we want a robust system. You don't need to calculate and computerize all of this. You want a robust system. Then I set my stop loss at double that, 40 pips. Got it? I'll explain where I'll give you more of this later. So, because a lot of people will ask, well, wait a minute, how long, how do you tweak all of that and so on? But that's my stop loss. By the way, the reason for using average range and double it is because the average range is just noise. A signal is when something moves double the average range. Okay, so that's my stop loss, and that is set at, let's say it was 40 pips, then that 40 pips is 2%. That's my position size. So I know my losses are going to be small because my system, as I explained, has very small losses, because as soon as momentum falls, it gets the heck out of there on a 2-period low. That's pretty tight. Momentum gone, 2-period low, bang, I'm out of there. But the other reason is because I've got a fixed loss where I can never lose more than 2% of my capital on any one trade. I can't lose more than 2%. That's one thing. But how do I make sure, if I'm only losing 2%, how do I make sure I get those big wins? That's where people go wrong. See all those people on a trading pit? You think they don't run their profits? When they're onto a trend, they don't just sit back and go, oh, great, I got a trend. Wow. Remember, the markets are only trending 20% of the time. You might have heard that. They only trend 20% of the time. Our job is to make sure on those 20% it's trending, we make 80% of our profits. 80-20 rule. You've all heard of that as well. Thank you, Siva from California. I noticed you've just joined. It is being recorded, and I'll make sure I send you the link. Good to hear from you from California. When you get those 20% of trending markets, which give you 80% of the results, you don't just sit back, treat it like any other trade. You got to add to it. You run your profits. Running your profits doesn't just mean not getting out. It means adding to the position, additional positions. How do we deal with additional positions? Guess what private investors do? Private investors add to losing positions, not losing ones. Not winning ones. Professional traders never add to losing positions. There's an old saying amongst professional traders: losers add to losers. Okay? Winners add to winners. Winning trading adds additional positions to winning trades. They add additional positions to winning trades. What are the rules for adding additional positions? This I look at when I'm trading. I start seeing in any given period the price consistently making new highs relative to the past period, I'll look to add up to 4 additional positions each time it does that. Up to 4. Why not more than 4? Because then it's not getting too diverse. Then it's getting too concentrated, not diversified. Because I'll end up with 5 positions in one trade in one time frame. Bit too intense. But wait a minute. What are the rules for additional positions for getting out? Well, if it makes a 1 or 2 period low, in other words, it doesn't follow through on those highs each time, then I get out. Now, this is very quick, in and out for those additional positions. I'll give you the rules already for buying and selling my initial position I'm now talking about additional positions only. I know we're running slightly over because I said 8:30. I will try and finish on time. So apologies that I've explained everything in so much detail. Why is this easy? Well, first of all, you've got demo accounts. What kind of earnings can we make on all of this? Is what I tell people. We want to try and capture 95 pips in a week. Okay, £10 per pip. That should mean £950 per week. Simple maths again. That should be £3,800 per month. £45,600 per year. Those in the United States, increase it by 1.5 to 1.6, and you've got how much it is in dollars, about $70,000. Okay, that's what we want to aim for on the FTSE 100. And why can we capture 95 pips in a week? Well, that's a reasonable expectation based on the signals as well. Now, how do you apply all this? So let's get into the logistics. How do we do all this? I gave you the rules. Well, what's behind it? Well, I said the platforms are free. MT4 platforms you'll have heard of. Many brokers offer it. They're free. That's the best thing. They're free. And you can open demo accounts. You're not even having to put money down. I love that because it means people can practice without risk. I want you to do that. I want you to download those MT4 accounts because they're free, sophisticated trading platforms, and you can open demo accounts. I'm not trying to sell you to open brokerage accounts and all the rest of it. Calculates the momentum and trends to produce entry and exit points. And the signals I've given you, I've told you, they don't require prior trading experience or knowledge. Because like I said, I'll show you the mathematics behind it, but like with a TV set, you don't need to know how it works in order to know how to get in and out. And there you go. Example of UK 100, so that's FTSE 100, UK 100, 4-hour chart, entry using my rules, exit, £15 a point in the case of this student, 2,280 in 12 days. That's what we're talking about. Okay. Here was the short end. Student number 2, again from London. Shorting, same rules, exit, 2,150. Now what would happen? This is just the initial positions, not the additional ones. The additional ones, the price keeps on breaking new lows, and you're looking at adding additional positions, particularly when it falls in a short space of time, a long amount, thinking, wow, there's momentum there. And you look to get out of those additional positions as it then moves sideways for a bit. That way you should capture, I'd say, roughly between 25 to 50% more pips than just by holding the initial entry and exit. You see that? So here, where we'd captured all this, we'd get through the additional positions about 25 to 50% even more. That's the big wins. That's the big wins. Thank you for some of the compliments coming through on the messaging. What are the backgrounds of people who do this? Well, given the rules that I've just explained to you, as you can expect, as you would expect, and this is a recent talk I gave at Bloomberg, students are everything from, and I know this from meeting them and speaking to them, everything from full-time moms to, and I'm sure some of them are full-time dads, they just don't describe themselves as such, to plumbers, and I'm assuming that's because plumbers earn a heck of a lot of money, professional traders, school teachers, retirees as well. Why should you use momentum trading? I haven't finished yet. There's a lot more. Well, I say a lot more. Just hold on for about 10, 15 minutes. I don't want people to think I'm wrapping up because it might sound like I'm wrapping up. The best is yet to come. The ability to outperform the markets is critical, profiting from rising and falling markets as well. Systems which are reliable, tested and proven, easy to follow, that's all got to be critical. And why can anybody do what I've said? Well, we need a computer, internet connection, download a free trading platform and a demo account, and you follow the instructions I've just given. So that's obvious. Okay? Why it's so easy. And what we're doing, we're copying the top traders. That's all we're doing. We're copying the top traders. Can't get harder than that. So the next question people then ask me is, can it be done automated? Well, EAs don't work. These EAs you might have heard of, robots, they don't work. Black box systems, they don't work because you've got to add those additional positions. You've got to do the position sizing to make sure your stop losses are exactly where they should be. And that's why they don't work. They can't work in all time frames, all currencies, all FTSEs and Dows and everything, regardless of the nature of the instrument, because the currency is different to an index by its very nature. So then people ask me, okay, Alpesh, does that mean we're going to be swamped by paperwork? Because we've got to go through each one of these time frames. And that's what I used to do. But like I told you earlier, there's computers and there's automation. That's the bit which I'm about to show you comes in next to make our life simpler, because you'll have noticed with all those charts, notice the nice little arrow which was on there. Well, I provide those, all those nice little signals. You see the line. So those who were serious about this and actually want to do this and follow this and make their lives a lot easier and not have to look with a magnifying glass at all of that, well, I created on the MT4 platform signals which give you the entry and exit points, and then put all of this down into a manual so that customized, personally developed, you can actually get all those signals. Because one of the things that we all know is we're going to have to learn new skills to make money because of all of these things. This is the reason, part of the reasoning behind me giving these webinars, and these things came up, and I know there's a demand because the demand has never been greater. I've had so many people asking me for things to do with trading and teaching them because of all these things, the credit crunch, the market crash, no more jobs for life, and all the rest of it. Because of all of those things, then got more and more people saying, okay, tell us how we do this. I said, well, look, I can't give personal coaching and mentoring. I can't just have you copying trades and so on, or training workshops and seminars. Just don't have enough time or hours in the day to do that. Just do not have the time to do that. So I created the software which gives you the buy and sell signals I've mentioned. Because let's face it, most people are not going to be able to sit down with pen and paper and go through buy and sell signals like I had to do to get my training to do this. Because computing power thankfully came along, and it removed the issues which keep on coming up. The software was created to remove these issues. Why does it feel like the market's out to get me? That's because you don't know when to buy and sell at the right point. I keep letting my losses run. That's because you haven't got the rules set up and your losses are not small. Some of my trades are profitable. Surely I have potential, but how do I sort out the loss-making ones? We've got to kill the loss-making ones by having proper rules as well. So how can you have these rules? With this in mind, I developed simple software to do this, designed to be used by private investors, whether new to trading or not, whether making profits already or losing, designed to achieve your trading goals. It doesn't work purely on FX. This is actually the FTSE 100 one I want to show you, and takes about 10 minutes to install. So I created it especially for the FTSE 100. People said, give me a FTSE 100 version of your rules. And that's what I did. Measures momentum, confirms the trends, qualifies the price moves, gives us ACT, assess, confirm, trigger. Works on rising, falling, sideways markets to profit and designed to protect against those losses. How do you use it? Use it on the free award-winning MT4 platform. What's better than having a free trading platform to use it? It's loaded onto the MT4 platform and produces clear buy and sell signals like the one you see on screen to save time. Got it? So you can use the rules already that I've given you, or you say, you know what, I'll actually get it done for me. Personal lifetime license to use my software on any of your computers. Access to members area, which contains videos not just on everything I've taught you this evening, but also a lot more on trading psychology and all the best bits from the world's leading traders. For those who want to go into a lot more detail, a 100-page trading manual I've written. If you don't want to go into more detail and you want to get on with it straight away, there's the videos, get you up and running this evening. Free copy of my original Bill Lipschitz interview. Remember the guy who head of global Forex for Salomons under Warren Buffett? Free copy of that. Free lifetime updates and access to training webinars, customer support for technical help, and invitations to future events. And coming very soon, twice daily audio market views. People wanted all of this, so I thought the efficient way to do it is this. And I wanted to pick a platform which cost them nothing. Working on any desktop or laptop, internet connection, and live or demo FTSE account. So then people ask me, well, what's the potential? What's the profit potential? I showed you what I target already. Profit potential obviously depends on your starting capital. If you've got no starting capital, the profit potential is obviously going to be limited. And the number of signals you follow. People say to me, oh, I've got a day job. That's not actually a problem. It's not an automatic robot because you're going to be placing the trades. Now, of course, past performance isn't a guarantee of future performance, and you've seen some of the typical winning trades. Stop losses. This is really important. Ensure we don't lose more than 2%. You can reduce it to just 1% on any losing trade. And the duration of the trades vary. Now, if you're doing this after work, now, because it's 8 a.m. to 9 p.m. for the FTSE 100 futures, you've got such a long period of time in which to trade as well. We essentially think, well, we've got people who've started as low as £2,000 on the trading because it's leveraged, so you can start with as low as 2,000. How much does it cost to develop? Well, okay, here's a bit of bragging. Okay, 25 years of education, because I get asked this, how much did it all cost to develop this? Yeah, well, 25 years of education is probably the easiest and simplest thing to tell you, as well as then using it on Bloomberg, BBC. That's why I showed you the magazines earlier on. It wasn't to brag, it was to say that this is what I use. That's what I want to get across to you on all of this. This is what's the back end of everything, and 25 years of education of it. And I thought about just giving it away for free, sending it there. And then where I have done, I've given you the rules, but I don't think it's sensible just to use the rules without actually saving even more time and having to. So I've tried to make it absolutely as free as possible. And it's actually next to free because there's a 30-day money back, no quibble guarantee. That's as free as you can get. No quibble, money back guarantee. 30 days. If after 30 days you haven't made money, just tell me. Just email me and say, I haven't made money. And there's a no quibble, no argument, money back guarantee. In fact, I'm going to go one better than that for you this evening. I'm feeling in a really good mood because it's still nice weather outside, actually, in London. So I'm about to go out. Just for trying it, I'm going to give you a free book for you to keep, just for trying it. From my trading shelf. It's actually one of the best trading books ever. I'm going to send that to you just for trying it. Just for trying it. Now, so that's actually better than free because I'm actually giving you something for trying it. That's how confident I am about it. I'm going to give you 2 recent testimonials. I'm really proud about this. Hi, Alpesh. Just thought you'd like to know. By the way, this chap has the same surname as me, but isn't related to me. Just thought you'd like to know. Purchased the momentum go 28th November, 450 on first trade, locked in profits, totaling 1.2k on second and third trades. Thanks, Raj. Sorry, that person doesn't have the same surname. The next one has the same surname as me, but isn't related. Dear Alpesh, this one has the same surname as me, but isn't related. I also attended the webinar you hosted 3 weeks ago on 2013 Outlook. On some of my Forex trading strategies. Using those strategies, so far I've managed to bag myself a comfy 1,000 pips. Started off with £5,000, made £5,000 at £5 a pip, totaling £10,000. It's only been 20 days. Thank you so very much for sharing your techniques. I got an email from this guy today, I mean literally today, and he's taken his grandparents on holiday to the US. I kid you not. And I say he says the same surnames. I'm probably related to him, but he's not a relative as far as I know to me. I'm giving 25 licenses. It's as simple as that. I only give 25 licenses. I only use. I do that because every time I've got to incorporate those into the training program in terms of the questions they might send and educate them and so on. And I can't just manage more than that. So every time I manage them, that's it. Then we might launch another 25. But also, after the 30-day period, for those who stick around, which most people do, I'm going to send you a copy of my 2 of my favorite books, which I've written. My online trading cookbook, which is my latest book, and Mind of a Trader, which was my first book, which I mentioned already. Give you free copies of those. But as I said, just for trying this, I'm going to give you a copy from a book from my trading shelf, just for trying this. Plus some more bonuses. I'm going to give you loads of training videos on setting stop losses, so things I've talked about this tonight, running profits, adding to winning positions, turning trading into a business, capturing enough pips to make a living, trading psychology, and understanding momentum indicators as well. Plus, you can ask me to make any custom videos to explain any aspect of this indicator or momentum trading generally. As a member, anytime you can do that as well. As I said, just for trying the indicator, a book for you to keep from my trading shelf. That's not my trading shelf. That's a bookshelf I wanted to show you an image of. I will give you a book from my trading shelf as well. I use this on the FTSE 100. We're just talking about FTSE 100 this evening as well. And what I've done is, as I said, first come, first serve, 25 licenses, ensure high quality support. That's the link to download 30-day, no quibble money back guarantee and a free book just for trying it. It's simple as that, just for trying it. The book, people have asked which book will I give. It'll be one of the ones from my trading shops. It's going to be one of the best there is because it's one of the ones that I've relied on. I don't know necessarily which one it'll be. This is it. Download the link. You'll see that. Click on that. Step 2 is you make the payment through big fat American trustworthy company, famous American company. Pick the currency of your choice. You can click on the bin to get rid of the extended download service. You don't need that. It automatically goes on there, but you don't need that. Step 3, download and read. Please read all of that. Watch the videos. They're brilliant videos. I've done them, and people sometimes don't watch them, and they're all there, everything that you need once you've done that. So download, read, and watch the videos. They're so good. And then load the indicator. It shows you how to load the indicator. You can't just double click on it. It shows you how to load the indicator. Any issues as well. And we'll get back to you. If there's any delays on getting back to you, just let me know. Give us a day or two to get back, but should not have any problems on that. And that's it. You sort of load it up, and you can instantly download the private indicator for the first 25 people. That's the link as well. Mutia, I've got your query. I will make sure that we reply to you as well on just on the indicator and how to load it and all the rest of it as well. Sorry for any delays. Right, making trading easier. So how does it work? Lifetime updates, one-time payment, members area training videos, invites to all my live events in the UK, full customer support, trading manual for those who want to go into more detail, loads of videos as well, and a book for just trying, and 2 books if after 30 days you want to progress, you're part of the team. We do that as well. What do you need to know? Works on any free, though I'm now saying, look, stick to FXCM because that's what I developed it on. It's New York Stock Exchange listed, big brokerage house, free MT4 trading platform. It's a free trading platform. The indicator sits on the internet connected PC or laptop. You can execute signals using any broker. I've put FX there, but any broker that offers FTSE 100, and you might place your trades through the Mac, PC, smartphone, iPad, Android, whatever it is. You can use the indicator for life, and we give free updates. It tested to work in all market conditions because we've been using it for years. Takes up to no space on your computer, and the documents, the webinars, are basically step-by-step spoon feeding as much as possible. It takes 10 minutes to load and set up as well. And you don't need to buy anything else. There's no hidden costs or ongoing fees. If you have any problems with loading it, 1 or 2 people are not very computer savvy, we've got support which will okay, our support might not be as fantastic as Microsoft, but we'll get back to you and teach you through the loading space. But actually all the documentation teach you that. And about 1 in 100 has a problem with loading, just in terms of they're not familiar with folders and drag and drop and all the rest of it. What do you need to do? Really simple. Once you've loaded it, you keep a watch on the buy and sell signals and execute them. It's not a robot, so you execute it because you want to be the trader. You're in charge. Place an initial stop loss like I just showed you so you don't lose more than 2% of your risk capital because we want to keep we don't want any big losses and we won't have them. We want to make sure we get big wins. Decide how much risk capital to trade with. Like I said, suggest $5,000, £3,000, £2,000 to £3,000, $5,000 on there. Keep your trading. Keys to trading success. What are the keys to trading success? Well, they're these. Step 1, we've already overviewed the webinar. Step 2, download the indicator and documents. That's step 2. Step 3, read the documents, view the videos on downloading the free trading platform and train. Step 4, open a demo, free demo or live account. Step 5, load the indicator on the platform. Step 6, start trading. That's it. You've done step 1 already. I say we get nice feedback, which I love, as you can imagine. I have to confess, I actually thought I would be returning the product, but But because of the guarantee, I took it up, and it worked. I couldn't believe it when the signals came in the direction predicted. And that's why I give the guarantee. Got nothing to lose. Plus, I'm going to say, even better than that, giving you a free book as well for trying it, because I'm proud of my work. Let me put it that way, as one should be. How can you get your own private license? And again, there's the link, alpeshpatel.com/download, and first 25 get on to that. This is for the FTSE 100. Be separate for FX. There's a slight tweaks to FX because the nature of FX is different to an index, and I'll do a separate email regarding that. How long do you have to order until the 25 are gone? Because I've got to then incorporate them into Q&A and queries and so on that people might have on trading. So for that reason, that's it. So once they're gone, they're gone. As it is. And why do I restrict it? People say, well, why do you restrict it? Well, I'm not going to do lots of webinars on it. The education, like I said, I don't have time to do live seminars or follow my trades and all the rest of it. This was really done to meet popular demand, people asking about it, and particularly as a result of the credit crunch, people saying, I want to learn more skills. The efficient end of the market is when something is online, and that's what we're doing at the moment. And the cost of the problem just increases with time, which is the other reason why I wanted to do it. So what's the recap? What you get? Instant download of my custom-made buy-sell indicator and software, step-by-step training videos on how to install, one-time payment, lifetime updates, invitation to all my events, monthly market update, training webinars, full customer support. You join the team. Plus another bonus, free 1-hour webinar on how to set up your own FSA regular asset management. Some people want to use this as a trading entity as well. There's the link. Instant download, full customer support, step-by-step instructions, trading manual for people who want to go into more depth, 100-page trading manual, videos on running profits as well, and placing stop losses. Those are really important. Video on turning trading into a business using my indicator, 30-day money-back guarantee, free book as well from me, customized trading videos for you on the indicator and momentum trading as well. Can't say fairer than that. And there is the link, alpeshpatel.com/download, because like I said, proud of my work. And especially today when I got that email, the person who's taking their grandmother, I know it sounds too good to be true, but they did have the same surname as me, which was really nice. What does trading mean for me? Well, for me, look, I set up my own asset management company. That's Richard Branson in Abu Dhabi with me, and then we've got, it's allowed me to do work for my government, which you can see there as a government deal maker with Vince Cable, but it's also meant that I've been able to do charity work. That's with Nick Clegg for something called the Lumbar Trust, Widows and Orphans as well over there that you can see that I've done, and more charity work. So look, one thing that I always say to people, I say this in my talks as well, so it's not just to do with the indicator, it's to do with the talks. When you make money from this, just allocate some to charitable works as well, please. I know you will. I hope I don't sound patronizing. Forgive me if I do, but do, because it sometimes with the markets feels unfair how easy it can be. I know education's hard, how easy it can be to make money. So do please remember how easy it can be, and I'm sure you all will do other charity work. And this is me also at various charity events. John Major and I are both trustees of the memorial gates, which commemorate the work of the Commonwealth soldiers in the First and Second World Wars, and that's me on the right with a familiar face at another charity function at the Ritz last year. And also, great thing about trading is when you're your own boss, you can just stick it to Jeremy Paxman. That's also fantastic as well, isn't it? So what's your opportunity? You get to join the community of traders. Give yourself the opportunity to earn that second income, build a career into full-time trading, gain skill, knowledge, and experience to trade. Give yourself the chance to take control of your financial future. Take the first entrepreneurial step to owning your own business. There you go. There's the link. Secret to getting ahead is getting started, and you just want to go on alpeshpatel.com/ download. Hope you found that incredibly. Don't I like Paxman? He's wonderful. He's a pussycat. There you go. I hope you found it handy and helpful, and you got the link there. Now, do tell me if there's any questions, because I'm sure there are on all of this, and pass them through before I log off. I hope you found it incredibly useful, but do let me know if you've got any questions on anything that I have said, and I hope that you do have lots of questions. Or maybe I don't. It'd be great if you don't, because it means that everyone just got it, and that's great. Bill, installments, yes, actually, yes, indeed. And that should be on the link. Thank you all for this evening, and help desk email, it actually just goes through once you've ordered. It's all on there. You'll get the link to the help desk as well once you're on there. And if you have any problems, let me just send you for the help desk what it is in any event. Any more questions? I'll just email that across to the purchasers. Thank you all for your kind comments. Love them, as you can imagine, as well. Yes, Mac. Does it work on Mac? It does. You don't need, there's two ways you can work on Mac. Either on your Mac, you've got Boot Camp, so you put Windows on there, or I've got instructions on how to emulate onto Mac, so it can be a little bit tricky. Most people that have tried it don't have, they have a little problem initially to get used to it, but after that they don't. And because it's, as I said, if you have any problems, hey, look, we'll solve them. So give it a shot, because we do have people using MT4 on Macs as well. So no problems there as well. How does it compare with any other products? I think it's look at specific for the FTSE 100 and for that system, and that's the point. Thanks very much, Chris. That I've twisted your arm. Say give it a shot. For those interested in FX, I'll send you a separate email on that in the next few days. This is purely FTSE 100. I said typical holding time, max 7 days. It all depends actually on the time frames you're trading, of course. What I mean by typical is, it's when people are actually trading. Some are. What I found is typically that's what the holding period people want is 7 days, but to a minimum of 7 hours. That's what I mean by that as well. And I will be emailing all of you regarding FX and this presentation as well, of course. Thank you very much for your kind emails. And so, yes, on FX, of course, I'll send you a separate email on that too, in terms of explaining all of this within a foreign exchange context as well. And also you can contact me via the help desk if you're interested in FX as well. So, and I'll give you that that way. I'll send you a link for that as well. Okay. Thank you all. Thank you. As I say, as a full-time job, I've got one person. Well, like I said, you want to start off small. You want to build up into it. And the figures that I gave you earlier were regarding going full-time on it. And then it's an issue of building up capital. If you multiply your capital by 2, then you earn twice as much, of course. And that's the point with trading. One other thing I want to link you onto is alpeshpatel.com/live in terms of FXCM and opening an account there. We've got a partnership with them. We like them because they're New York Stock Exchange listed. In terms of how the rules are different with FX, the nature of FX is that it tends to what's called mean revert. It tends not to go in one direction, unlike an index. So the rules are just slightly tweaked for that in terms of the entry and exit signals, and that's all. And that's for me. And I notice the nature of momentum in FX tends to be slightly different to indices. And you'll notice if you look at an FX chart and an index chart, you'll just notice the differences when you just look at them on that. So I just want to thank everybody this evening for participating, and I'll be emailing you all shortly as well. So really, thank you all. Thanks very much.